this Friday, 11:59, right? And the solution will be available, right? If there's no nothing happened, right, or emergency happened, then should be available at 12:01, right, Saturday. Okay. Now Black-Scholes. If you look at Black-Scholes formula, it gives you the call premium, right? And I told you if you use the one period binomial model and you break the period into, let's say, millions of sub-period, and each will be a very short period of time, and the answer will approach to the Black-Scholes formula. So that means Black-Scholes is continuing compounding. That means every second the return is move up and down. Yeah, that's true in reality because stock market is traded continuously. That means the return is changing every millisecond, right? Even after hours. So don't believe, okay, the markets end at 4, then there will be no trading. No, because the price today closed and tomorrow open, the difference actually is the return over that period of time. Now, even after the market close, let's say suddenly there's another announcement, let's say 5 p.m. today, and if it's good news, then tomorrow when the market opens, you expect prices will be up because of that news. All right? So that means market is continuing compounding. So Black-Scholes formula is based on continuing compounding. All right? Okay? And we call this continuous time finance. Now, if you look at this equation, it says the core premium is equal to the stock price right now time ND1, right, minus E, that's exercise, right? If you want to use X for this E, and then this E to the minus RT, and then ND2. Now, if you compare this formula with our replicating portfolio, our replicating portfolio is, well, the call premium is equal to the stock price times delta minus the B. So you can see the similarity between the two, all right? So basically, ND1 is a delta of the call option, all right? And this, if you remember what you learned in Fc10, this is the present value of the strike price, or the present value of the exercise price, okay? And using continuous compounding. Right, so this is just the present value of the strike price. If you can write this as present value of the strike price or the exercise price. Now, ND2 you may interpret as the probability that you will exercise this call. So if you look at a deeply in the money call option, ND1 is 1, ND2 is also 1. Because if it's deeply in the money, you are almost sure you will exercise this call option. So ND2 will be equal to 1. Now, if this call option is deeply out of the money, then we know delta will be 0. Now, ND2 will also be 0. That means you almost have no chance that you will exercise this call option. All right? So that means this is your expected value, the probability of exercising. When you exercise it, you need this amount. So you can see this is just the expected money you need when this option expires. Okay, all right? Now, what is ND1, ND2? Now, ND1 is based on normal distribution, a standard normal distribution. So ND1, a standard normal distribution, we know the mean is 0. Right? It is from negative infinitive to positive infinitive. All right? That's a normal standard distribution. Now, if the D1, let's say if the D1 is here, and D1 actually is the area on your left-hand side, or the probability that the value is less than D1. All right? So this is just the probability of the value is from negative infinitive to D1. Okay? Now, if you want to find ND1, you need the probability density function table, the PDF table. Now, you don't need to copy the table on your crib sheet. If it is needed, I will provide that information. All right? I will give you a list. You can choose out of the list what the ND1 is, what the ND2 is. Okay? And if you calculate D1 is just lateral log of the stock price over the strike price plus the risk-free rate. So I told you R in option theory is always the risk-free rate plus the variance, right, or the volatility, the variance of the underlying asset divided by 2 times T. Now all variable in Black-Scholes formula, they are in year. So this is the annual rate, the effective annual rate compounding continuously. And this is the annual volatility. And this is number of years of the maturity of this call option. So everything in years. Okay? So yeah, this is just the variable. Okay. Now, to find the price of a call option, they are altogether, if you look at the formula, they are altogether 5 variables. The stock price, the strike price, the risk-free rate, the volatility or the standard deviation. Well, if you have standard deviation, of course you get the variance, and the time. So that means if you have all 5 variables, then you should be able to find the call premium. All right? But in reality, we don't have all 5. But we can have 4 of them and observe the call price. Because this is the price in the market. All right? So this is the underlying asset value. Let's say if it's a stock, then you can still do the stock exchange and find the stock price. And this is the strike price of the call option. Definitely you should know when you buy a call option, you should know what the strike price is. Right? And this is the risk-free rate. You can go to the Bank of Canada website, or in US, you go to the Federal Reserve website and find out what's the risk-free rate for that period of time. Right? And time T is the maturity of the call option. Yep.
So the question, in the formula for the Black-Scholes, is the negative exercise price times our negative RT, is that itself PV?
Yep, that's the whole thing is a present value of E.
Okay, just that.
Yep, the whole thing is present value of E. And the next term will be the probability that you will exercise the call option. So that means what is the expect amount you need at maturity of this? Let's say if the probability is 0, then even though the present value of the exercise price is 100, doesn't mean anything because there's no chance you need the $100. Right? If the probability of exercising is 100, that means yeah, you will need $100. So today you probably need the present value of 100. So at maturity you have 100 to exercise it. All right? So in this formula, we can observe 5 of the 6 variables in total. So that means we don't know the missing variable, that is the volatility of the underlying asset. Now when I say volatility, it's not historical volatility. It should be the forward, that means future volatility. Right? Because this is a price today, right? And this is exercise price, it's fixed in the contract. And this is also fixed in the contract, and this is the risk-free rate you can find in the website, right, from Bank of Canada or Federal Reserve. All right. So now what we can do is, hey, let's work backward and use the observed call premium in the market and find the implied volatility. Right. So this is similar to what we did when we have bond pricing. Remember? If you know the yield to maturity, that's the required return of the bondholder, we can discount all promised cash flow and find the bond price. But the issue is we don't know the required return of the bondholder. But we observe this is the market bond price. Right now they're trading at this price. So we work backward and find the implied required rate of return. That's the yield to maturity of the bond. That is, if you observe this price, then you go backward and find what's the required return of the bondholder. So this is the same thing. we observe the call premium, and then we work backward and solve for the price volatility. That is, when the market determines this call premium, what do they have in mind about the value of this volatility or standard deviation? All right, so that's the in-price volatility. Now, the in-price volatility, whether it will be consistent with the standard deviation of a stock. Now, if you do not have any extra information, historical volatility is a good proxy. That is, this is the best guess we can have based on past volatility. All right? So what we do is, if you calculate the in-price volatility, so this is your in-price volatility, and compare with your estimation of your volatility. This is your belief. Right? This is, you believe this. So assume that you believe the annual volatility will be 10%. Right? And if you go to the market and calculate the in-price volatility, and you find this is 20%, now this call option or even put option the same is overpriced. That is, you should, according to your belief, you think 10% is the future volatility of this underlying asset. Then you will use this 10% to determine the price. Right? So you find this. Right? But the market, they're using this to price the call option. So that's why they get this one. All right? So therefore, this one will be greater than this one because they're using a higher volatility, higher standard deviation. So last week, we know, we talked about the relation between call option, put option, and volatility. Higher volatility, higher call premium, higher put premium. All right? So if the market uses a higher volatility to price this call option, then this call will be overpriced. All right? So if you observe this and you believe you're right, the market is wrong, so you should sell this call option. Right? Now, on the other hand, if the market prices is 20%, but you believe it should be only 5%, now in that case, your calculated or your true value of this call you believe will be larger than the market price of this call right now. So in this case, you should buy this call option. All right? Okay, this is just purely trade on call option without looking at a direction. All right? Because, well, if you think the underlying asset is up, then you buy call. If you believe the underlying asset is down, you buy put. Right? But this one is you try to find whether the call option or put option is mispriced. All right, and you want this trade based on that. Yeah.
Sorry, did you write it correctly that with the volatility of 5%, it is still going to be bigger than 20%? With the variance of 5% and then variance of.
Oh no, sorry. Let's see. Yeah. Okay. Yeah. Oh, I'm sorry. I should use 50%, or any 30%, right? Thank you. Right. Yeah. Thank you. Yeah. To be greater than. Well, that one doesn't say 20, 10, 20. Okay. Silly. Okay. Yeah, this should be larger. I'm sorry. That should be larger. That means you believe the underlying asset volatility or standard deviation is something larger than the in-price volatility, then this stock should have a high value. Then you should buy it. All right? Now, one thing you need to be very careful, because I don't want you to blame me, let's say after several years, and you're broke, and then you say, okay, Derek told me that, well, I should do this. All right? Because if you do this, you can lose everything you have. It's not possible. Don't forget, this option, they have maturity. Right? Let's say 1 month. Assume this is true. Assume this is the second case true. All right? Assume, okay, you believe this will be $20, and now this is only 10. And you go to the market and buy. You spend. You sell your house. and you sell your lunch, you sell everything, right? And then you just buy all this call option, right? $1 million invested in this call option, but you may lose everything because, yeah, you're right. The volatility should be higher. The market may be irrational longer than 1 month. That means your maturity of this call option is 1 month. It expires, and your option will expire out of the money. When your call option expires out of the money, you lose everything. And then the next day, the market thinks, oh, you're right, the standard deviation should be 30%. But it's too late, right? You're so unlucky for that. So if you want to just purely trade option because of mispricing, you need to hedge. So the simplest but not a very effective hedge is what we call delta hedge. So that's why you need the delta. So if you buy one call option, then you should sell delta shares. So in case the price is down, that's the market crashes, all right? So your call option will expire out of the money, but your short position stock, you make money, right? Because when you sell or you short this number of, so you sell, so this short, this number of shares. So that means you will make money from the short position to hedge the risk of market crashes. Okay, so that's what we call delta hedge. But this delta will keep changing when time is shorter, closer to maturity, and the market price move up and down. Question? Okay. So that means a delta hedge is not a perfect hedge. You still have to do more. So the second one will be delta gamma hedge. That means you need to also set your portfolio will be delta neutral, gamma neutral as well. But again, it's still not a perfect hedge. So that's why you have so many delta gamma and so on and so on. So what you learn in risk management or derivatives. All right. So there are many, many different variables in option theory. All right. But at least you should have at least a delta hedge. Okay. All right. Now this is the Black-Scholes. This is the put call parity and find the price of a put premium, right? Because the we only have the equation for call. We only have the equation for call, and we don't have a formula for put option. So therefore, we use the put call parity, and we substitute. So this is the present value exercise, right? You write it here, and then you replace the call premium by the Black-Scholes formula. And then you rearrange the equation, you have this equation, this model, all right? So that means if you want to find a put premium, you also need to find ND1, ND2. And then you subtract it for 1, and this one you multiply by the present value exercise price, this one you multiply by the stock price. Okay, so this is how you use Black-Scholes formula to determine the put premium. Okay? Now this is just a simple example, assuming the stock price right now is 50 and the exercise price is 45, the maturity is 6 months, and the discount rate, the risk-free rate is 10%, and assume you know the future standard deviation is 28%. So now I want you to find the price of a call and the price of a put, all right? So using the Black-Scholes formula to calculate D1, so the lateral log of 50, the underlying asset over the strike price, right? Plus the risk-free rate, plus the variance divided by 2, and times the number of years, all right? And here this is the standard deviation times the square root of number of years. And you should be able to find D1 is 0.884, D2 will be 0.686, all right? So check the normal standard deviation, normal distribution function, right, table, and you should be able to find that ND1 will be 0.812, ND2 will be 0.754. All right, or you can use Excel, the normal distribution. So this is normal standard distribution, so standard normal. All right, and then you should be able to find the call premium should be $8.32, and the put premium will be $1.12.7. Yeah.
Where does the 0.50 come from?
0.50, 0.5, this one here. This is the T, time, because half a year, 6 months. 6 months, half a year. So everything in years. Alright? So this is the annual standard deviation, this is the annual risk-free rate, and this is the number of years. Okay, right? So next, now next we will look at warrants and convertible. So what is a warrant? First of all, a warrant is very similar to a call option, all right? But this time you do not deal with another investor. This time you deal with the company, right? So let's say this is IBM. This is IBM. Now a call option will be just A and B, right? An option on IBM stock is just a gamble between investor A and investor B. Okay? But if it is a warrant, now this time it is the IBM and the investor C. So this is option, or call option, this is the call, and this is warrant. Alright? Okay? So this is the IBM and C. So if C exercise the warrant, then IBM, they have to issue a new share to C. So that means you can see the number of shares will increase when someone exercises the call or the warrant. But for call option, the number of shares outstanding remain the same. Alright, because it's just a deal between investor A and investor B. Okay? So company usually they include warrant as part of the security they sell. Usually, let's say if you look at SPAC, Special Purpose Acquisition Corporation, when they sell the share to the investor, each share will include one warrant. Alright? Okay? Now, since it's look very similar to a call option, then is price movement, right? The profile will be very similar to a call option. Okay, and we will look at how we calculate the price of warrant today. And we know again this is the same upper band. That means the warrant cannot be more than the share, right? Just like call option. And this is the lower band, which is the intrinsic value. Alright? So when a call is exercised, then no new share will be issued. Okay, so just one share will be transferred to another investor. Alright? So that will be no effect on the firm's value or anything happen to its financial statement. Number of shares outstanding remain the same, equity value, everything remain the same. But when a warrant is exercised, then a firm, they must issue a new share. Or they have to, let's say if they have some treasury stock, and they have to give the treasury stock to the investor when they exercise the warrant. So that means no matter what, the number of shares outstanding will be higher. Right? Now we call this a dilution effect. The existing other shareholder, their ownership will be diluted. Right? Let's say in the past, they own 10% of the company, now they will own less than 10% because the number of shares outstanding is high right now. Okay? Now we'll look at this dilution effect using a very simple example, comparing a call option and a warrant. Alright? So assume a very simple example. This company, it only has 1 unit of asset, which is an inventory. Right? That's the only thing you have. So that means the T account initially is like this. So they have an asset that has a value of 500 today, and they have liability 0, and equity must be 500. All right. So this is the current situation, and assume that 2 shares outstanding. So anything in red that represent per share value. So there are 2 shares outstanding divided by 2. That means share price will be 250 today. Alright, and T1 and T2, they are the 2 existing shareholders. And we want to consider the following 2 cases. case number 1 is when T1 sell a call option to T3, right? And let's assume the price is $8, all right? And this call option is at the money call option, so the strike price is also equal to the stock price, which is $2.50, all right? And we also assume, okay, let's assume that T3, this person has enough money to exercise the call option, right? So make sure that this person now they have $2.50 and $8 for the call option. So they pay $8 for the call option, and they have, let's say, $2.50 in their bank account. All right. Okay. Now case number 2 this time is the firm sell a warrant, at the money warrant, to the new investor T3, and assume the price is also 8. Now later on we know the price of the warrant should not be 8, right? But let's assume it is 8 for comparison purpose. Right? Just make it easier to compare the two. All right? Assume there's 2 cases, and we want to see what happened to company financial statement, what happened to the share price. All right? Okay. So assume that at the end of a month, or maybe just one day, doesn't really matter, right? If you say, oh, how about the time value of money? So if you assume one day, then yeah, the time value of money is almost nothing. All right. So let's assume that there's no time value of money. Okay. And it's either the price will be 400 or 600. So we want to look at option case first. All right. Now for option case, we know there are 2 possible outcomes. So the price of that, right? So this is when the asset of the value, so I just put asset, okay, asset is equal to 400. Right? Second case is when asset equal to 600. Right? So when asset equal to 400, so that means this asset value is 400, and the firm has loan liability as well, and equity value must be 400. So if you divide it by 2, then share price will be 200. So in this case, this option will expire out of the money, right? And then we look at now what's the final wealth of these 3 individuals, right? Now T1 is start with $250 in wealth because he owns 1 share. T2 also owns 1 share, which is $250, and T3 is start with $258, right? And we want to look at right now what will be their final wealth and their gain and loss, right? So it's T1 own the share because it's the option expire out of the money. So T1 still be the shareholder of this company. So he owns 1 share, which has a value of 200 now. And he also received the $8 option premium from T3. So now the total wealth is 208 compared to the initial value of 250. Then T1 actually lose $42. Right? Now T2 did nothing, so therefore his wealth is right now equal to 200. So start with 250 and add 200, a loss of 50. So this you can see compare, if you write a call for this case, your loss will be less than the other investor. All right? Now the T3 new investor just lose $8 because well, this call option expire out of the money. Okay, right? So that's fair enough, right? Okay. Now second case is when the price of the asset is 600 right now. So now the liability is 0, equity must be 600, and you divide it by 2 share outstanding. Right now share price is 300. All right. So if the share price is 300, this call option is in the money, and T3 will exercise this call option, right? So now what we have is, okay, since T3 exercised the call option, T1 will receive the 250 exercise price. So the ending wealth of T1 will be a total of 258. The $8 call premium plus the exercise price of 250. All right, so that's only a gain of 8 compared to T2. So that means T2 did nothing, and the wealth is 300. So an increase of $50. All right, so I just want to comparison purpose. You compare T1 and T2. All right, now T3 this time will exercise the call option by paying $250. So at the end, this individual will own one stock, right? And the stock has a value of 300, so that means a gain of 42. All right? So this is very simple for option. Everybody should know. So now we want to move on to warrant. All right? So the same thing we wanted to. So this is the initial case, right? So this is asset 500, liability 0, equity is 500, and now you divide it by 2 shares outstanding, that is 250. So this is the initial case, right? That's what we have at the very beginning. Now, this time the company issue a warrant. And the warrants we assume is $8. But this $8 belongs to the company, right? The company will receive $8 from T3. So if you do the calculation, if you write out the T account or the balance sheet of this company after the issuance of the warrant, it should be like this, right? We have asset of 500. Right? We have asset of 500 because this is the very beginning, nothing happened. And you also receive a cash of $8. All right? Okay? And if liability does not change, equity must be 508. Right? So that means share price will be 254. Right? Now, this doesn't make sense. This doesn't make sense. You cannot make money by just issuing equity. If you increase share price by $4 by just issuing warrant, why not issue 1,000 warrant? Why not issue 1,000,000 warrant? If you issue 1,000,000 warrant, then everyone with $8 with $8 million, then the share price will be 4 million and something. Doesn't make sense, right? You cannot create except Bitcoin, right? For crypto. You cannot create value from thin air. All right? Okay? So we know there must be something wrong with this T account. All right? And the thing is, we forget. You do not create any value by issuing this warrant. Actually, you have a liability of $8 here. Because you owe someone an obligation. You owe them an obligation. That is, if they want, they can buy the company share at $250. So that means you may have a chance to lose value. If the price is higher than $250, they make money, that means the company will lose value. All right, so this is your future liability. Because as a warrant writer, you have the obligation to sell the stock at $250. Right? If expire out of the money, yeah, of course, you'll be happy. But if expire in the money, then the firm will lose value. So that's why we need to report an $8 liability. Because this is a market value balance sheet. Even though accounting, they're moving towards the current value accounting. So even now, if a company issue option, they have to report the liability on their balance sheet as well. Okay, so we know, I believe I mentioned this, finance is somewhere between accounting and economics. We use economic theory and we use financial data, right? But economics, as an economist, as an accountant, they're losing their job, so they are moving towards in finance, right? Because finance is where the monies are. So they need to find money, so they have to move. So even accounting standard, they're changing the accounting standard right now. Not reporting historical transaction, but trying to make future financial decision. All right? So therefore, you should report a liability of $8 in this case, because you will owe someone certain value in the future. All right? So that means the equity should also remain at 500. So if you divide it by 2, the share price stay at 250. Right? You cannot create by just issuing security. All right? But the market is irrational. Trust me. If you look at MicroStrategy, they just issue convertible bond, they just issue preferred share price increase because the hype of Bitcoin, right? But it's, this is actually a good experiment, trying to prove the economic theory is correct or not. But it may take a little bit of long time to prove it, right? Just that's the same thing, tariff, whether it's good or bad. Right? In human history, we only have a few small sample. Right? Of course, I don't like tariff, but from an academic point of view, this is a very good experiment to see whether a tariff will lead us to recession. That's another experiment. Right? You don't have many chances to see this kind of thing in real life. So actually, it's good because no matter how many times you discuss it, it's all in theory. All right? And there's nothing you can prove is right or wrong. So now that's actually a great experiment, I would say. All right? Okay, now let's move on to the case when the asset value is 400. So now this time the asset value is 400. The liability now is 0 because this warrant is expired out of the money. So now you don't have any liability. You really earn this $8. All right? So when we report this $8 liability, is similar to unearned revenue in accounting. Right? You receive the money from your customer and you do not deliver the product or you do not provide the service, you cannot report it as a sales or revenue. You only report it as unearned revenue. That is, you debit cash, you credit unearned revenue, which is a liability. All right? But now you provide a service. You deliver the product to your customer. So this time, you debit unearned revenue, and then you credit sales. All right? So you will realize this transaction, this sale. All right? So the cash, of course, will be $8 right here, and this time your equity will be 408. So if you divide it by 2, that's 204. All right, share price will be 204. So in this case, now both shareholders, their loss will be less, right? Compared to $50 earlier, right? When T2 did nothing, right? The loss is 50, but now it's 46 because of the warrant. All right, and T3 just lose $8 because the warrant expired out of the money. All right. Now next will be the final case when the asset value is $600. So now you can see the asset have a value of 600 and you have cash of $8. Now the liability is also 0, right? Liability is also 0. So if nothing happens, stock price will be $304. Right? Just like in option, the price is 300, but this time it's 304 because of $8 warrant premium. But don't forget, this warrant expired in the money. So T3 will exercise the warrant by paying $250. So the company will receive $250 from T3. So total asset this time will be $858. So that's why we have this $858. All right, and so now equity must be 858, but now we have 3 shares outstanding, so that's equal to a price of 286. Now this is the dilution effect compared to option. When you compare to option, the stock price is 300. All right, because you don't need to issue a new share. The number of shares outstanding remain at 2. But with warrants, the company, they have to issue 1 new share, so now share price dropped to 286. Okay, just $858 divided by 3. So now if you look at the gain, all of them make money, of course, because the asset value increased, but T1 and T2, especially T2, the gain is only 36 compared to $50 in the option case. In option case, $50, right? But it's now 36, so that means a loss of $14, right? And T1 also has a loss of $36, so all go to T3, the 28 right here. Okay, so this example is to illustrate the dilution effect of warrants. All right, so any questions? Now, so the factors that affect warrants value will more or less the same. So if you look at it, this is similar to what we have for call option. Positive relation with stock prices, negative relation with exercise price, and positive relation with interest rate, positive relations with standard deviation, positive relation with expiration date. Now, negative relation with dividend. Normally, warrants last for longer period. All right, warrants sometimes can be 10 years, can be 20 years. All right, warrants normally they have a longer maturity. Most of them more than 1 year. Some of them even 10 years, 5 years, quite common. All right, so during the 5-year or 10-year period, very likely the company would pay dividends. So here we include a dividend. Now, dividends is a carrying cost of warrants, right? Because you have warrants, you do not exercise, you do not receive a dividend. The higher the dividends, the more opportunity cost you have, all right? And also don't forget, dividends reduce stock prices. Remember, right? When you pay dividends, stock price will decrease, right? And some warrants, they may adjust for dividends. That's possible. And warrants normally adjust for stock split. Okay, that is, if you have a split, they also adjust the exercise price of the warrant as well. Otherwise, the company keeps splitting, then the warrants will never be in the money. Okay, but normally dividend, they would not adjust the dividend unless there's a very special dividend more than, let's say, 20% or 50% of the company asset. Otherwise, they should pay no adjustment for dividend. So higher dividends, that means lower stock price. So that means that means there will be a lower warrant premium. All right. Now to determine exact the value of warrants, let's look at this pricing right here. So let's assume S is the equity value or the market cap of this company, right? And X is the exercise price. And N is the current number of shares outstanding, and NW is the number of warrants outstanding. So here we assume 1 warrant, you can buy 1 share. But you may have 1 warrant can buy 10 shares, 1 warrant can buy 20 shares, doesn't really matter. All right, but let's assume 1 warrant, 1 share. Now the gain from exercising a call is just, this is the market price, right? The current equity value, the market capitalization of a company. So the term they use in the market is market capitalization. That's the equity value. You can think of it as just equity value, all right? And divided by number of shares outstanding, so that means the share price. And X is the exercise price. So if you exercise this call option, the gain will be this value or 0, right? It's negative, you would never exercise. So let's assume you exercise it because it is in the money. All right. So this is a gain from exercising a call option. Now the gain from exercising a warrant will be like this, because if you assume this is a number of warrants you can exercise, and X is the strike price, so this is how much you will receive. So in our early example, this is $250 because the strike price is $250 and we have one warrant outstanding. So the company equity value will increase by $250, right? Because the firm just received $250 equity, right? So this is the current equity value, and the equity value will be increased by $250. Now it's okay. Now, but the number of shares outstanding is also high. So the total number of shares outstanding will be the original number of shares outstanding plus the number of shares we issue when you exercise the warrant. Right? So that means this is the new share price. In our early example, this is 286. Alright? And so this is the exercise price. Alright? So 250. So this is your gain from exercise of warrant. Alright? And now what we do is let's do some manipulation about this formula. So since you're moving around, this common denominator and multiply everything is, so this is just multiply 1. I did not do anything, just multiply 1 and take the common denominator and cancel some of a term. You end up with this expression. That is the gain from exercise and warrants is equal to this factor n over n plus nw times the gains from exercising a call. Alright? So that means the gain of exercising a warrant is just equal to something times the gains from exercising a call option. So that means the warrant premium should also equal to that little factor times the price or the premium of a call option. So if you want to determine the value of a warrant, just treat it as an ordinary call option using Black-Scholes formula to determine its price, and then multiply it by this dilution factor. So this dilution factor is always less than 1. So warrant price will always be less than option price because of the dilution effect. All right? Okay. Any questions? All right. So if you compare warrants and right offering, the issuance of the two, now warrant, the company will receive money, $8, but right, they are free because rights, they are dividend paid to existing shareholders. So no cash inflow. Now maturity, right, they are short term, so usually a week or two, but warrants much longer maturity. Exercise price, we know rights must be less than the current stock price, right? Can be anything below that. But warrants can be in the money, can be out of the money, and be higher, can be lower. But most warrants, they are issued out of the money. Okay, most of them, they issue out of the money. That is the strike price, they are higher than the current market price. Okay? And then we take a 10 minutes break, and after the break we look at convertible. Now during the break, if you have time, read this article. This is an article a few years ago about Warren Buffett, how to use convertible or actually warrant investing in certain companies during the financial crisis in 2008. Okay, so please come back at the same
De ahí tuve que trabajar en esto. Esto lo hice ayer, a la 1 de la mañana.
¿Tú usas marketing?
Lo de marketing es lo de acá. Esto igual lo acabé hoy en ayer en la mañana, pues. No, hoy en la mañana. Tuve que hacer esto. Ah, no, esto lo trabajé ayer.
¿Nada más?
Y marketing, está acá. ¿Cuál era marketing? Ah, y marketing. Y esto que trabajé yo en la mañana.
No tiene tanto espacio en Google Storage, Google Cloud.
Creo que borré cosas por accidente. To be fair. Y de este todavía me falta hacer la presentación. El otro de acá me falta. Es que tengo unas cosas.
Nada más. Nada más.
Y eso todo es para mañana.
Nada más.
Sí, puta. Pero mira, es que esta madre está de que se ve súper profesional. Y de ahí lees lo que estoy diciendo, es pura mamada. O sea, lo escribí.
Mándamelo.
Superman escrito. No, es que todavía no lo tengo.
No, es que no sé qué escribir en el 5M.
¿En cuál?
5M. Marketing, money, no sé qué mierda más.
Ah, no, este es de. Este es de otro.
Pero vean, gusta de que compré este de aquí. Ya.
¿Sabes lo que yo hice? Porque.
Este es mi último, el reporte. Es de una compañía de verdad.
Ah,
Pero yo siento que esa compañía es
pero
como...
¿no tienen que hacer el case?
Sí, también. Eso es lo que estoy haciendo.
No, el case está fácil. ¿Sabes por qué?
¿Por qué?
Porque solo sacas de un artículo que es verdadero, o sea, en español, lo traduces y 0% de.
Pero es una compañía de
todo.
verdad.
Por eso,
Pues no voy a sacar aquí.
nosotros lo estamos haciendo Nike.
No, es una compañía toda un startup.
Ah,
Por eso.
vamos.
No existe. No existe nada de esa compañía. Dije,
Ay,
quiero buscar
no.
quiénes son tus
¿Por
clientes.
qué lo hicieron de eso?
No, lo eligió el profesor. Sí, trajo al CEO.
Ay,
Pues, es un niño de 24 años.
te valieron madres ahí. No, nosotros nos dijo de que Juan Rey, porque en el primer año, ¿te acuerdas nuestro case de marketing? ¿Es eso? Oye, están haciendo, pero les hicieron de que lo pusieron una compañía. Nosotros agarramos un case existente que está en español, copiamos todo, o sea, no cambiamos ni una puta palabra.
¿Cuánto sacaron?
85.
Verga.
Ese nos dieron, de ahí colgamos con Academic Penalty porque era como más de 20%. No cambiamos nada. Y no sé por qué no cambiamos, de que ni lo parafraseamos, nos valió verga. Ahí lo mandamos y nosotros todavía más con Marcos. ¿Qué será de Marcos?
Un grito de mierda.
¿No has pensado? Yo creo que ese niño estaba como con 1.3 de GPA. Yo creo que lo sacaron. No, ni yo, cacho.
No sé, nunca he llegado a uno.
And he gave me one extra day.
Pero yo le apliqué la mía.
Yeah. I just like
Dije, ay, si no me encontraron una vez, no me encontrarán dos veces. En el de marketing igual, tenemos que hacer ¿qué hice?
I get one extra day
Ya
now.
todo esto solo
So I
agarré
have
un
a little bit of
artículo
reading.
en español. Sí. Le pegué la traducida del año y ya.
¿Qué compañía era?
La primera que hicimos fue la también. Plan.
I don't know. No, I think it's all as well.
¿Nunca lo he escuchado?
Bro, if
Eso es
we're
lo que
rich,
uso para ir
we're
a
getting each other Rolexes, bro. I'm poor.
Chilena.
¿Así grande?
I mean,
No, algo así para aerolíneas panameñas y gringas.
I'm so concerned sometimes.
Ay, Dios mío. Esta clase es más difícil.
Quiero dormir, quiero dormir.
Ari, dime que esta examen está fácil.
What do you mean you're gonna ruin it? Is it gonna be like,
¿Está parecido?
throw it away after?
La primera vez. O sea, lo estás diciendo tú de que. Es que solo tiene una cosa parecida. Entonces. No, pero la.
Is it recoverable by any chance?
BIC es lo mismo, pero calcular el dividend del diferente año.
willing to increase my budget. And he's very close with people.
Ah, sí.
Get a paintball gun and shoot him in front of you.
While I'm wearing it?
No, no.
Okay.
Like,
Porque tengo que ver si lo voy a comenzar a revisar mañana en la noche. O pasado.
I'll start shooting it. And then you can unwrap it. By unwrap it, I mean
Yeah.
there's supposed to be something inside the explosive.
Yeah.
This is so retarded.
No, oh my god, you're gonna love it.
I gave it a retarded.
It was so much fun.
So I was thinking,
I did not study at all.
just
No, they are super nice too. Like they have a lot of programs and a lot of things happening. Everything's like free, super cheap. No, are you go? Which campus are you going to? Seoul?
I'll be studying for my exams during my birthday.
Because one, it's too far. There's nothing around it.
Okay, and when I'm doing it, I will give you both gifts on your 21st.
I'm still waiting for it. I took marketing and data analytics, and then I took the Korean course for the language requirement.
He also complains as a president.
And I took
Or we never there.
I took just photo communications because that I'm gonna
yours
tell
is
you,
doing
it's
something.
so difficult to get into the courses.
His is
Really
later
difficult.
than
So
yours. I know that.
do it as long as it opens, like as soon as it opens, just try to do it because I was traveling there while was a course registration. I didn't make it to any of the courses that I wanted.
I'm still recording.